All right, let's talk about the one language that every single business on the planet speaks, from the corner bakery to a multinational corporation, and that's the language of money. In this explainer, we're going to dive into the grammar of that language, accounting, so you can understand the story any company is telling. So what is accounting really? If you're picturing some old school bookkeeper, let's update that image. Think of it more as a powerful information system. Its job is to identify what's happening with the money, record it all properly, and then communicate that story to the people who really need to know. Okay, so here's our game plan. First, we'll figure out who is using this information and why. Then, we'll look at the different legal ways you can set up a business. After that, we'll get into the 3 core activities that every company performs, and finally, we'll learn how to decode the 4 key financial statements and see how they all fit together. Let's get into it.
Okay, first things first, who are we even preparing all this information for? It turns out there are a couple of very different groups of people, and what they need to know really shapes how the whole story is told.
You can basically split everyone into 2 big camps. First, you have your internal users. These are the people on the inside, the managers, the executives, who need this information to make the day-to-day decisions required to run the company. Then you've got the external users. These are the folks on the outside looking in. We're talking about investors who are thinking about buying shares, creditors like banks deciding if they should give you a loan, and even government bodies like the Canada Revenue Agency making sure you're paying the right amount of tax. All right, now that we know who's reading the reports, let's talk about the business itself, because how you decide to structure your company right from the get-go has huge consequences down the line, both legally and financially. The simplest form is a proprietorship, the classic one-person show. It's super easy to get started, and the owner has complete control. But, and this is a really big but, in the eyes of the law, the owner and the business are the same thing. There's no separation. So if the business goes under, creditors can go after the owner's personal assets. Your house, your car, it's all on the line. A partnership is pretty much what it sounds like, a proprietorship with more than one owner. The upside is you get a broader set of skills, more resources, and more financial clout. The downside, though? Well, that massive risk is usually still there. The partners are typically still personally on the hook for the business's debts. And that brings us to the corporation, which is a total game changer. A corporation is legally considered a separate person from its owners. This creates a protective shield called limited liability. It means the owner's personal assets are safe from the business's debts. This is exactly why it's the structure of choice for businesses that want to raise a lot of capital and grow. Even though it is more complex and expensive to set up, this idea of separation points to a golden rule in accounting, no matter the business structure. It's called the reporting entity concept. It just means that the business's financial life and the owner's personal financial life must be kept completely separate. You can't use the company bank account to pay for your personal vacation, period. So what do all these businesses actually do? Well, no matter how big or small they are, you can sort all of their actions into 3 main categories. Let's think of this as the engine room of the business. First, you've got financing activities. This is how a company gets its fuel, the money it needs to start up or expand. It can do this in 2 main ways, by taking on debt, which is borrowing from creditors like a bank, or by issuing equity, which means selling off small pieces of ownership to shareholders. Okay, once a business has its fuel, it needs to buy the engine. That's what investing activities are for. This is where the company uses its cash to purchase the long-term assets it needs to operate, things like machinery, buildings, software, and vehicles. And finally, we have operating activities. You've got the fuel, you've got the engine, now it's time to actually run the business. This is the core day-to-day stuff, selling products, providing services, paying salaries, marketing, basically everything that generates revenue. So how does a company actually report on all this financing, investing, and operating? Well, the results are all neatly summarized for those internal and external users in 4 key documents. Just think of these as the company's official report card. Yep, just these 4 reports. But when you put them together, they give you a complete and powerful story about a company's financial health. The first one is the statement of income, which you'll also hear called the profit and loss, or P&L statement. It measures a company's performance over a period of time, like a quarter or a year. It really just answers one simple question. Did we make money or lose money? Second, there's the statement of changes in equity. You can think of this one as a bridge. It takes the profit or loss from the income statement and shows exactly how it affected the owner's stake in the company over that same period of time. The third report is the statement of financial position. but everyone just calls it the balance sheet. Now, unlike the others, this is a snapshot in time, what the company looks like on one specific day. It lays out the most important equation in accounting. Assets equals liabilities plus equity. What you own has to equal what you owe to others plus what you owe to the owners. And fourth, we have the statement of cash flows. Profit is nice, but cash is king. This statement is critical because it tells you where the company's cash actually came from and where it went, and it breaks it all down into those three activities: operating, investing, and financing.
Now, here is the most important part. These four statements are not just separate standalone documents, they're all deeply interconnected. They flow from one to the next to create a single cohesive financial story. And this is exactly how they connect. Look, the net income from the statement of income flows right into the statement of changes in equity. Then, the ending equity from that statement gets plugged into the statement of financial position to make sure it balances. And for the final check, the ending cash balance on the statement of cash flows has to match the cash number on the statement of financial position. It's a beautiful, self-checking system.
Of course, this whole process isn't the Wild West. It's governed by a comprehensive set of rules called Generally Accepted Accounting Principles, or GAAP. These rules make sure everyone is reporting information in a consistent way, so we can compare one company to another. In Canada, public companies use a global standard called IFRS, while private companies have the option to use a simpler standard known as ASPE.
So, to wrap things up, I'll leave you with a question. If you were starting a new business tomorrow, knowing what you know now about the trade-offs, the control, the complexity, the personal risk, which structure would you choose? Would you go with a proprietorship, a partnership, or a corporation? Your answer really says a lot about your goals and your tolerance for risk.